Welcome, everyone. My name is Inkem Izamama, and I'm grateful that you're spending this Thursday evening with my team and I. So before I start, I just kind of want to everyone here, and if you're listening to this after the recording is out, right? Everyone is successful. Sometimes by conventional standards, we have all climbed the ladder of some sort. We've worked to increase our income, and we've done everything that we've been told to do to make us wealthy. But here's what nobody told you, right? They didn't tell you that earning money and building wealth are two completely different things. And it almost feels like you're playing two completely different games. And so tonight, I'm going to show you how to stop playing that earning game and to start actually winning the wealth game. What does it really mean to start thinking like the wealthy and to start building like the wealthy? By the end of this hour or so, right? I want to be able to help you understand why ownership is not just an investment strategy, but it's the only strategy that actually leads to true financial independence. We have to start thinking that we have to start owning things, right? Because every dollar that you earn working for someone else is a dollar that stops when you stop working. So the second you stop working, your earning power stops. And so tonight, we want to change that equation. So once again, thank you for joining. If you have any questions, please feel free to drop it in the chat and I will address it right after. Before we dive in, I just want to take a moment to address something that I think is very important. Everyone who's here, accomplished professionals, we understand the value of due diligence. So everything that you hear here, I want you to take the information and know that it's exclusively for you. And as much as I love sharing these opportunities, right, I encourage you to review anything that I've said, any opportunities that we put out, any investment deals that we talk about. Talk it over with your trusted advisor, because I think that's what sophisticated investors do. And I want to make sure that I let you know that you should do that as well. So let's talk about what really matters here today. And here is an uncomfortable truth, right? Our education system, our employers, even our financial advisors, they have trained us to be high performing employees, not wealth builders. So we don't really know how to build wealth. These same people and the system has taught us to optimize our earning, but they haven't really taught us to start owning. And so the result is that, you have professionals, you have doctors, you have lawyers that are making $300,000, but who cannot afford to retire. Or you even have lawyers who are billing $300, $400, $500 an hour, and they panic when they get sick because they're like, well, how will I make that money? And so I don't think that's financial success. And I think you would agree with me, right? I think that's just sophisticated poverty. And you're sophisticated, but you're still trading that time for money, right? Which means that you're still poor in the only metric that matters, which is freedom. What does financial freedom really mean? A lot of us have been conditioned to believe that more income equals more wealth. But I think the data tells a different story. And as you can see on the screen, right, 76% of Americans, they live paycheck to paycheck. That's 3/4 of us. And that even includes people who are earning six figures, right? The problem isn't the income, it's how we allocate it. So I think it's more of an allocation strategy. And that's what I want you to start thinking about. And so I'm glad that you're here tonight so that we can think through it, talk about it, and then figure out, how to shift that equation to our favor. And this is the fundamental question that really separates the wealthy from the well-paid. And yes, it's great to be well-paid, but why don't we think about how we can take it to the next level? If you look at this equation that's on the screen, right, what you'll notice is that the income doesn't even appear in the equation. Now, you have to understand that your salary, what you make, right, is the fuel. So those are the assets that are the engine to help you build wealth. And a lot of wealthy people, truly wealthy people, they understand. They understand this because then they use their earned income, which is really important, but they use that to acquire assets. And then those assets that they acquire, they start to generate unearned income. So that's how you have to start thinking about it. What is my earned income doing for me? The wealthy, they don't just work for the money, right? They actually start thinking about how can this money work for me? Where are the places that I can put my money, my hard-earned money, to work for me? Now, the disclaimer here is that you need to have hard earned income, right? You need to have income so that you can use it to now, think about ways to build wealth. Think about putting it in income generating assets. But that's where you have to start. So you have to start with what you have right now, which is your foundation, which is your work. And this is why, and this is something that is kind of warped in our brains, right? This is why maybe a school teacher who buys rental properties or who invests can retire wealthier than maybe a surgeon who only lives and saves off of his 401k. If you look at these two profiles, right, the higher earner has double the income, but they have almost 1/10 the wealth. And that's because that income is just continually getting spent with the hopes that all they'll do is retire off their 401k. But the difference in that school teacher is that she is systematically converting her earned income, even though it's significantly less, but she is converting that into income producing assets. So every dollar that she doesn't spend becomes a soldier that's working for her in her, like what we'll call maybe a wealth building army. But that's how you have to start thinking about. Again, if you look at that equation, right, income doesn't even appear in it at all. So I want to get very specific with numbers because, again, math doesn't lie, right? That doctor is making excellent money, but she's trapped. She needs to work 2,000 hours a year to maintain that lifestyle. And one sick week might cost her $8,000. And 1 month off work could maybe cost about $35,000. The asset owner, right? The person who owns assets is generating $240,000 while they're sleeping. Now, it's not one and done, right? And it's not like the first year, but it's as you start growing, as you start adding more, that's where that 240,000 could look like. And that's where that number comes from. But that person is generating that money while they're sleeping, while they're traveling, maybe while they're spending time with family, while they're homeschooling their kids, whatever that looks like, right? That's what you have to start thinking. But here's the kicker. The doctor could actually become an asset owner and could do so much more. Imagine if that doctor invested, let's say, $100,000 in like cash flowing assets, right? Instead of just like upgrading her lifestyle. If she starts investing in assets that are cash flowing, imagine what that could look like. Within 10 years, right? She'd have way more passive income than most people's actual active income. Now, it takes time again, right? This is not done year one or year two, but when you start building, you start laying the foundation, and you start getting that, you start investing in those cash flowing assets. And so the problem, which a lot of people think is like a capacity, right? The problem is not capacity. It's really allocation strategy, which is what I talked about 2 slides before. It's what are you doing with the income that you are generating? And that crossover point where passive income starts to exceed maybe like all your living expenses, everything else that you need to survive, that's where financial freedom, that's where financial independence comes, right? And it's really achievable for people who are listening to this conversation, right? This, because you're starting to think like, how can I make this happen? What do I need to do today? What are the income generating assets? How do I need to start thinking about ownership today to set me up for the future, to set my family up for the future? That's how you start. And that's why you're here today, how you should start thinking. Most people get stuck right there. I'm going to share with you 6 steps. And a lot of people get stuck in step 1 and 2. And the reason why is because they start to increase their lifestyle every time they increase their income. And it almost feels like this hedonic treadmill, right? Because you're running faster and you think you're going somewhere, but you're really not going anywhere. And a lot of people, a lot of wealthy people, they break this cycle. They increase their income, but they maintain the lifestyle that they're at, right? So they don't, so that like that difference in their increase in income and their lifestyle, they start deploying that into assets. And I want you to make sure that you understand this and you realize it, right? Step 1, which I told you about keeping your job as the foundation, right? Step 1 is about maximizing your earning power. So that's really becoming excellent at what you do, maybe negotiating your work, potentially even changing careers for higher income. But that step 1, right, is the first step, which is the foundation, which is I need to figure out how to maximize my earning power so that then I can have the income that I need to start investing. Now, step two, again, I told you step one and step two is where a lot of people get stuck, because step two is maybe living at your means, right? It's not living cheap. It's not by any means living very, very cheap, but it's living strategically. And the target is maybe a 30% savings rate. That's what you're thinking about saving, because you're going to use that. That is going to be where you start thinking about investing from. And step three, I think, is where a lot of people fail. So these are the steps to like how to start thinking about ownership and building wealth. And the reason why step three is where most people fail is because they save money, but then they don't know how, where to deploy it strategically. Remember, I told you it's about asset allocation. So where are you putting these funds in, right? So your savings account, if you know, like it might get you, your actual savings account get you like, I don't know, 0.5 or something. And maybe if you did a high yield savings account, you might get like 3-4% depending on the bank. But that still isn't investing, right? It's still just parking the money somewhere. Real investing, actually, now, so you have to start thinking about like, where can I deploy the capital? How can I deploy it into assets that are generating 10 to 15% annually, right? That's when your money starts working for you. So what are the vehicles that you can use to get that? Now, this is kind of where it starts to get a little exciting, right? Which is like step 4 to step 6, because this is where compound growth starts to take over. You start, your assets start buying other assets. And so that's how you start thinking about compounding. You start thinking about income generation. So maybe your properties will start appreciating, right? Anything that you're investing, and they'll start generating cash flow. And then your equity becomes, equity from one thing becomes down payment for more properties or more investment opportunities. So step 4, I think, is more about direct ownership. So it's more than just like owning stocks. Like if you're just a minority stakeholder in a company, right, where you don't have control, but you need to start thinking about, okay, how can I start owning assets that will help control my income stream? So you have the foundation, which is your work, and now you're building your saving, and now you're deploying it into different investment vehicles that can get you 10 to 15%. And that's when you start thinking about ownership. Step 5 is where you start thinking about like intelligent leverage, right? You start thinking about diversification. You start to use the equity, maybe the equity from one property, and you use it to invest in 1, 2, use it to acquire more. And you start spreading risk across many different markets, many different property types. So that's what step 5 looks like. It's where you start becoming a little bit more savvy in what you're doing and how you're using your money. And then step 6 really looks like financial independence. It's when your assets, all the things that you've invested in, when they start generating enough passive income to cover your lifestyle, right? That's when you start thinking about, okay, I have reached financial independence, financial freedom. Now, this isn't easy, right? This takes a lot of education, strategy, dedication, growth, and it takes time. So it's not something that will come in a year or 6 months, right? It takes like really being creative about how you are growing your assets and thinking about diversification. And this is truly how people start to build generational wealth, which is a word that is thrown around, right? It's really not through saving, but it's through just thinking really deeply about systematic asset acquisition, right? So it's like, where can I put my money in? Where can my money grow? What can I use that growth to continue to do to help further the growth? That's what you should start thinking about when you start thinking about like, how can I systematically grow in order to get me to financial independence? And at step 6, right, you've achieved what like less than 5% of the population ever achieves, which is like true financial freedom, true financial independence. Like I said, it's not easy. It's not like a 6-month journey, a year journey, man. It's not even a 5-year journey, right? But it's really, but in that time, there will be so much growth that maybe the next 5 years, then this really becomes a very, very big possibility. Now, I will tell you this, right? Real estate is maybe one of the only asset classes that gives you multiple different ways to make money simultaneously, right? your tenant will pay you rent every month. And so that's how you're getting cash flow, right? So that's one. And then the property will increase in value over time, right? That's appreciation. So you now have cash flow, you have appreciation. As a real estate investor, you're going to get tax deductions, right? You're going to get it from depreciation. So as the properties is depreciating, the actual property is appreciating. So as you're getting depreciation, the property is appreciating. That's tax benefit. So you have cash flow, you have appreciation, you have depreciation, and then inflation. So what inflation will do is it'll make your fixed rate debt, so like what you're paying, 5% debt, it'll make it cheaper over time while your rent is still increasing. So that's how when you hear the word like inflation hedge, it's that inflation's happening, but your interest rate is staying the same, but your rent in the property is increasing because of inflation. I want you to test me and show me another investment class that works just as hard for you as real estate does. And this is the reason why, and this is what excites me, right? It's the reason why truly 90% of millionaires own real estate. That's why a lot of them make their money through real estate. It's not because that they love being landlords, right? But it's because real estate really provides those multiple return drivers, right? That will compound over time. I told you this is a long-term mindset. This is a long-term play. And that is why tons of millionaires actually make their money through real estate. So while stock investors will hope for like 7% annually over time, right? As a real estate investor, you start systematically thinking about how you can achieve 12 to 15%. And you can really do it through these 4 pillars that we just talked about, because they're all working together to help you achieve that goal. That excites me, if you can't tell. So I want to talk a little bit more about the tax benefits, because, the tax benefits alone can be worth 20 to 30% of your investment, even just in the first year, right? Because you're making money, you're saving on taxes, and you're building wealth simultaneously. That's the beauty of I almost feel like it's like a beautiful irony, right? Because the IRS lets you depreciate the property on paper, right? But the property is actually appreciating in value. And so you get this tax benefit of a loss while you're experiencing cash flow of a gain. It's really cool. I think it's just wonderful. And sorry about that. And this is it's truly a legal tax optimization, really at its best, right? And for a lot of high income earners, that let's say you're in the 35% tax bracket, $100,000 real estate investment, you can generate about, in today, 2025, right? You can generate about $23,000 in depreciation deductions. And that looks like maybe saving about like $8,000 in taxes. That is almost an 8% return from just tax savings before you start thinking about cash flow, before you start thinking about appreciation. And so when you add all these benefits together, that's what makes it really exciting. So I talked about that, but then there's 1031 exchange, which maybe I don't talk about as much, but that's when after you sell a property, right, you can defer all the capital gains because you have to pay capital gains taxes. But if you sell a property, you can defer all those capital gains taxes and you can roll the proceeds into another investment. It has to be a like kind of investment that you roll it into. But when you do that, then you can defer paying those capital gains tax because you're investing in another property. And that is how wealth builders, they legally avoid taxes while they're continuing to grow their portfolio, because they're just rolling over their proceeds and the benefits into another property. This is a definition of a long-term mindset, because they're like, I might not be winning today, but I'm growing my portfolio, I'm increasing my assets, and it's compounding over time. And so some of the kind of objections that people say, they're like, well, I don't know if I can do it. It might not be for me. But like the most common objection that we get is, I think sometimes it's incomplete information, right? Yes, you want to buy an investment property directly because you're like, I think that if I buy it, then I own it and it's mine, right? But when you think about that, right, when you're trying to buy a property, you probably need $200,000 or more for down payment, plus closing costs and reserves, right? But that's like saying that's like almost saying that you can't invest in Apple because you can't afford to buy the whole company because you don't have the money, right? But that's the cool thing about syndication, because with syndication, right, you can pull all your money together and you can pull it with other investors, and you can buy institutional quality properties. So you can buy big properties where you're still an owner of it, but you're sharing the risk. So instead of buying a $300,000 duplex by yourself, right, you can own a piece of like a 25 million or 30 million dollar apartment complex, and you are still an owner. And the economics are so much better, right? The management is professional, so you don't have to manage it yourself. You don't have to deal with tenants and toilets. And then the barrier to entry is low, right? Because with real estate syndications, you can start off at 50, you can start off at 100,000, and it's achievable for a lot of high income professionals. You don't have to start off with a larger amount, right? And maybe you're not buying someone else's mess or someone else's problem, right? You're sharing the risk with a lot more investors, and you're buying just a piece of a really amazing institutional grade quality asset that's going to be managed professionally. So you don't have to deal with all those, all the downsides to owning, but then you are reaping in all the benefits. And another obstacle is knowledge, right? You don't have to be a real estate expert. You just need to be a really intelligent investor who can evaluate real estate opportunities. And we talk about that a lot at Phoenix. We have tons of webinars where we're talking about how can you become a smarter real estate investor, right? And there's a huge difference, right? A real estate expert is someone who maybe knows how to fix toilets and handle evictions, but an intelligent investor knows really how to evaluate the operator. You understand risk, risk adjusted returns. You get that. You understand how capital is allocated. But then guess who's building more wealth, right? Long term, because you're focusing on the 20% that really matters, which is you're understanding the financial metrics. You understand like what is cash on cash return. We talk about how to evaluate market fundamentals. We talk about how job growth is important, population growth is important, where we buy is important, right? All of those things are things that we talk about and that as a real estate investor, as an intelligent investor. So my team is going to drop a book that we created, and it's called a Passive Income Playbook. I think we put it out maybe a month or two ago, but it goes over in detail really how to evaluate a market, the investment types, thinking about how to vet a sponsor, how to really think about market analysis and market dynamics. But all of it is really how to make the best decision when you're considering passive investing. Now, that's the 20% that really matters, right? The other 80% is like property management, maintenance, tenants, legal stuff. And that's all stuff that like the professionals handle, right? Our third-party property management. You're not buying a job, because you don't want another job. You already have a job. You're buying an investment. That's how you have to start thinking about it. And this is kind of the breakthrough that changes everything, right? You can own real estate without becoming a landlord. You can benefit from all the 4 pillars that we talked about: cash flow, appreciation, tax benefits. You can benefit from all of that, right? Without any of the operational headaches. And this is how busy professionals are really building wealth through real estate. They invest in real estate. They don't have to operate it. Active real estate investing means that like you're buying, you're managing, you're maintaining all these properties yourself. Again, this is truly a second job. It's not an investment, and you and I don't want that. But when you start thinking about passive real estate investing, it means that, you can evaluate the opportunities, and you have to do that really well, but that's why you're an intelligent investor. And then you partner with experienced operators, you receive quarterly distributions, and you're still an owner, but you don't have all the headache. So your time commitment is maybe reviewing the monthly reports that we give you, jumping on quarterly calls, and then the professionals handle everything else. So you get all the benefits of real estate ownership with, again, none of the headache. That's the beauty of what your time, how important your time is. And so you might be wondering, like, why is this a perfect time to invest in real estate, right? It's because of this. And I want to talk about kind of 3 things that make this the right time. And it's interest rates have been, if you understand what's been going on in the market with interest rates, right? They have been the defining factor in real estate markets over the last like 3 to 4 years, right? We've seen rates go from anywhere from 2% to 7%. And now they're stabilizing around like 5 or 6, right? But this creates a unique opportunity, a unique window because properties that were purchased or refinanced at 3 to 4%, they're now distressed, right? They're distressed really from a financial standpoint because these loans are maturing, but they're maturing in today's rate environment, right? And a lot of these also owners are over leveraged. And so they're really being forced to sell. And at the same time, right, the Feds recently pivoted. Like that recent pivot suggests that like we may have seen the peak, right? Because we think right now we think that it's going down. But so smart investors like you, if you're listening, if you're here tonight, you're positioning yourselves for right now, right? Before the rates potentially like really decline, although I don't think they'll really decline. I think they'll decline slowly, but before they start really declining, and then competition increases, right? So this is kind of that window. And this is almost like that contrarian investing that Warren Buffett talks about, where he says, buy when others are scared. And so you're positioning yourself, at least you're thinking about positioning yourself for the recovery before it's obvious to everyone, before everyone sees what's happening. It's like, oh, we should buy. Almost feels like 2008 again. But this is what people don't understand about the current market, right? There is, I talked about this a few weeks ago. There's about $1.5 trillion in like commercial real estate that's going to mature over the next like 2.5 years, right? And a lot of this debt, like I told you, it was originated at really low interest rates, and it was originated for very short term. Now, a lot of these owners are facing refinancing, but they're facing refinancing at today's rates, which look like 200 to 300 basis points. So that's 2 to 3% higher. And think about that, or even more than that, but that's like significantly destroying their cash flow. So they can't refinance, they can't hold. The only thing they can do is sell, right? So it almost creates like this motivated sellers because they need to sell, but then really like they as much as they're motivated, right? They're still selling below market because of what's happening with like their interest rates and the fact that like it's financially distressed. So what you have is that like you also have institutional investors who have maybe stepped back a little bit from the market. So it's like less competition, but for really, really quality deals. This is what happened, I told you, in like the 2008 to 2012 era. And a lot of investors who invested then, right? And now think about that, that's 10, 12, 15 years ago, right? Those people have built generational wealth. I told you it was over time. And so right now, I don't think like it's not really going to be a crash, but we're really positioning ourselves for opportunities so that when the market dislocates, right, you're right there. Like we are right there to benefit from that. So another thing I just kind of want to touch on is that demographics, we don't think about this, but they really drive market demand. And the demographic trends today, they're really favoring rental properties. Millennials, all of us that were born, can't remember the years, 81 to 96, right? We are the largest generation in history right now, and we have surpassed baby boomers. And the millennials are in their prime household formation years. So that's like building a family, living, they're getting married, they're having kids, they're needing larger living spaces. But what you notice is that this generation is also the most mobile generation. They're changing jobs, they're changing cities, they're traveling, more than like the previous generation, right? They're not buying as much anymore as you would have expected the baby boomers to buy in this like same season of life. So that creates this sustained rental demand, right? Because the and supply is kind of staying the same, but the demand is going up before they maybe transition to home ownership, right? But that right now is this peak of rental demand. Plus, there's this idea of like continued urbanization. So people are moving to job centers, they're moving to like high growth markets. And all of that again is like this sustained demand pressure, and it's all for rental. So when you think about that, right, that's how you think about. So we just talked about what is happening with interest rates, and also now what's happening with the demographic market. All of this kind of really cool convergence doesn't happen often, but it has created really motivational sellers and favorable financing, right? And then that strong demand. Again, it feels like 10 or 12 15 years ago. But this time, I think as you're listening, a lot of us are more prepared for this time around, right? This time, maybe we have capital that's sitting that we're looking for the right ways to deploy it. This time we understand the game. We're more educated, right? And so we have smart money that is already moving, and we're positioning ourselves for the right time. If you also think about it, and I've talked about this as well, like private equity, they're waiting to deploy almost 250 billion, and they're looking for distressed real estate opportunity. Even pension funds are also increasing their like real estate allocation. Family offices are buying aggressively. So everyone understands kind of what's going on today. And so the question I want you to be thinking about is, the question is not like, should I invest in real estate, right? The question is, can you afford not to invest in real estate, right? Because windows like this, they don't stay open for long. It's just like a really cool opportunity where everything is kind of coming together, and then figuring out the right time to start deploying capital. And in 2009, a lot of us were, when real estate was cheap, right? A lot of people were too scared to buy. And then by 2012, it was very obvious. And at that time, prices had recovered and things just became too expensive. We are at that window right now, like that 2009, 2011. And so the question is, will you move with how smart money is moving, right? Or will you just kind of watch at the sidelines, watch from the sidelines and kind of regret it later? That's what I want you to be thinking about. And that's what brings me to tonight's opportunity, which is the Rise. It's not just an investment opportunity, right? It feels like the right entry point into this ownership paradigm that we keep talking about and that we keep thinking about, right? How do I move from, just working and just making to now start thinking about owning? It's how you go from, how can I get my time back? Because now your money's working for you instead of just you working. It's about, how can I also take our power back? Because now we're building assets instead of just earning income. And that's the step, right? It goes from just making to start owning. Almost feels like also questioning, like, how can you take your peace back? Because at the end of the day, your goal is financial independence, financial freedom, and so that you have the ability to choose, right? To choose the type of life that you want. So I want to show you exactly what this looks like. This investment opportunity is only for accredited investors, and that's that. So if you have heard about this opportunity and you're ready to jump in, our team is going to put a link to our secure portal. Now, this portal has all the information that you need. So it has the detailed investment deck. We'll go over it today, but it has that so that you have access to that. It has subscription agreements. It has operating agreements as well. All of that you'll have access to. And at any point, like I said, please feel free to drop questions in the chat, and then I'll be able to answer it at the end.
We are at Conyers, Georgia. We're at the Rise, and we are acquiring this amazing asset for our investor community. Today, we are doing due diligence, and the entire team is here. So we are looking at every single property. We want to make sure that what we assumed on paper is actually what we see in real life. But we're also doing financial audits. We're looking at the rent receipts. We're looking at everything on paper as we compare what we're about to purchase. So we have been here since 10 a.m. in the morning, and honestly, the feedback has been amazing. What we have reviewed has been really good. As much as this is important to us at Phoenix Capital, we have to make sure that our investors know exactly what they're getting, what we're purchasing. So I've had the opportunity to go into some of the units and actually walk the units. And this is a pretty new property. It was built in 2022. I can already tell that our maintenance cost is going to be low. So if you guys don't know, this is probably really exciting. 20th Century Fox and Warner Brothers, they are actually expanding their studio to Conyers, Georgia. Because one of the things that we look for is is the people who are coming into the area. So the types of jobs that are growing in the area and the types of opportunities that are coming. So the fact that these people are here is very exciting because it is building the Conyers, Georgia population. And those are the types of things that are very important to us as we think about location and when we do market analysis. It's what's even better is proximity to Atlanta. So it's less than 30 minutes away. So people can actually live here and work downtown, and the commute is barely anything. For me, this has been such an exciting opportunity, and everything that I have seen has reinforced exactly what we're doing at Phoenix Capital. I am truly excited to bring this opportunity to our investors because this is just yet another way that we can grow wealth through passive income in real estate.
Okay, so let me tell you a little bit about the Rise. It's a 128 unit apartment complex. It's in Conyers, like you just saw in the video, and it is a Class A property. It was built in 2022, so it's about 3 years old, and we are acquiring it for 25.3 million. It is, and we got very favorable financing. I just talked to you about what's happening with interest rates, and we are getting fixed rate of 5%, and it's truly located in the path of Atlanta's continued expansion, and we know how much growth is happening. But the numbers are just the beginning, right? I want to show you why kind of the area is really special. Within a 30-minute drive, you have almost 19 billion that's in committed corporate investment. So these are things that are like shovel already in the ground, that's already starting. And like I said, these are not announcements, these are not promises. They're actual projects that are already going, and they're going to bring in about 20,000 jobs to the Atlanta MSA, so the Atlanta area in general, and Conyers will benefit from all of that. This is the importance of market analysis, and this is kind of why that passive income playbook is really good, because you will learn and you will understand the reason why we select certain areas and why we only invest in certain markets. It's where the growth, it's growth trajectory, it's where it's going. And this will be a snippet of everything that I tell you tonight. Just know that the full investment deck will be available in the portal, and you can always get access to it. So I want to talk about returns. A lot of our investors, this is kind of one of the first questions they ask. What are my returns? What am I getting? How can I start positioning myself to start owning? And for this deal, we structured the investment into two different options and two different classes. We have Class A, which is for investors who just want steady, predictable returns, but it's at a lower risk. So you're looking at about 10% average annual return. And then Class B, it's really for those who want to participate in the upside potential of the property's growth. So you're thinking about profit share at the end based on appreciation. And so that looks like around 16.1% average annual return. So that's on a yearly basis. Both of these, otherwise, you will receive quarterly distributions. You will all these different classes. You will still benefit from the tax advantages that come with owning the property, which is depreciation. Okay, so I want to walk you through what a sample $100,000 investment looks like for Class A and Class B, and this looks like kind of year on year. Like I said, either one, you're going to receive quarterly distributions, and that will start about first quarter after we close. So after we acquire, a quarter later, after we kind of go through stabilization of the property, you will start getting distributions. So you start getting returns, and those will pay out until we exit and we sell the property. And the reason why I kind of want to break this down so that you can see it is that so that this doesn't just become like theoretical returns for you, right? You see that they're based on our conservative underwriting, but also a proven ability to execute with similar business plans that we've done. And so this is a sample class A investor, and the projected returns you're looking at getting is, this one is kind of steady and it's 10% every year. So that looks like $10,000 yearly. And then you will get full return of your capital in year 5. And the projected return is going to be 150,000 because 10% every year. And so you're looking at 1.5, so 1.5x your initial investment. Like I said, this is steady, it's predictable cash flow throughout the entire period. And then class B, this is a sample $100,000 investment. And I did 100 just so that it's so you can see a clear comparison. But the minimum investment for this class is 50,000. And so the distribution ranges, it's different from year 1 to kind of year 5, but you will still get like your full return of your capital year 5, and then you'll participate in profit share at year 5 as well. So your $100,000 investment looks about like $180,000 at time of exit. So it looks like about 16.1% on average, and that looks like about 1.81x your initial investment. If you're thinking about like which one should I pick, right? Think about your risk appetite and think about how much cash flow you need today. If you can kind of help yourself answer those questions, it will tell you whether you want to be in class A or class B. And this is kind of where it gets really exciting. I just want to give you an example. I told you about, the physician and the teacher and what the example looks like. But let's say that you decide to invest in the Rise, right? And you did $100,000 in class B. Over 5 years, right? You receive $180,000. Now think about if you reinvested that $100,000 in another deal, right? And then let's say another one comes and you roll it over so you don't pay capital gains. And then 5 years later, right? That 180 now looks like 326, or it could be better. But this is the kind of like just like conservative underwriting, conservative numbers. And so if you invested again that 362, well, that looks like now 590. And if you invested that 590,000 for another 5 years, right, that looks like over 1 million. Now this is 20 years, right? This is not like 1 year. So you didn't invest $100,000 and made $1 million in a year, right? This looks like something that would happen over time, and it's compounded and it's strategic. And that's what it looks like over 20 years. This is not get rich quick. This is truly get rich systematically. Again, this is long-term, right? So you're thinking long-term play, long-term gain. And the beautiful part is like you're doing this while you're still continuing to excel in your primary career, whatever that is. And also you're doing this while you're diversifying in other different asset classes, asset types. That's how you have to start thinking about, again, wealth generation and ownership. I talked to you a little bit about kind of the benefits, the tax benefits. And one of the most powerful benefits for real estate investors is tax efficiency, right? And for every property that we invest, we do cost segregation so that we can get depreciation, and then you can get bonus depreciation. So through depreciation, right, you can reduce your taxable income significantly. So for someone in a high tax bracket, this can be worth thousands of dollars annually. And this is the tax code. Like it's written to really incentivize real estate investing. So my question is like, why don't you take advantage of it? Say on a $100,000 investment, you could get $23,000 in depreciation. And then, and you're using that. So if you don't use all of that, it rolls over into the next year. So a lot of my investors are not a lot, but some are first-time investors. And so at least they're first-time investing outside of their primary residence. And so a lot of them ask, well, how do you mitigate some of the risk that comes with investing, right? Because at the end of the day, you are still taking some risk, but we have structured these deals very conservatively. And one of the things is our loan, right? We are about 60% leverage, which means that we have a lot of equity cushion. We're bringing a lot of capital to the table. And not only that, right, we use professional property managers, and that's really helps because then they know how to manage properties our size, the type of demographics in the properties, and they have measurements or measures that they have to meet on a weekly basis, on a monthly basis, on a yearly basis to make sure that the property is being managed exactly how we want it to be. And so and then we also have experienced operators, right, who are now managing and operating the property. And those are day-to-day operations. More importantly, right, you're investing with a team that has acquired multiple assets and who are managing millions in real estate. So that's some of the ways when you think about like how are we mitigating risk, how are we, how is our approach, how are we thinking about it from a conservative standpoint. Those are all the markers that we have in place to help make sure that every step of the way we're thinking about our investors. So before you ask, like, how can I trust you with our investment, with you? How can I trust you with this investment, right? I want to kind of show you our track record. And this is what we've done, over the last 3 to 4 years. But more importantly, 4 months ago, we acquired Grove Park View, and it was a $49.1 million apartment complex in Gwinnett County, Georgia. Our Grove Park View investors, we said 1 quarter after closing, we'll start distributing, and they're going to get their first quarterly distribution next month. It's not someday, it's not eventually. It's we hit the ground running, and we started the work that needed to be done to be able to manage our properties really well. And so the business plan is working exactly how we projected, and maybe not exactly. There are things that we had to, like fix along the way, because not everything that we saw on paper when we got into the properties, there's certain things we needed to fix, but that's just part of owning, right? But the systems are in place and the team is proven. So our investors are starting to get returns back. They're starting to get distributions. And so the rise is that next step in the journey. And it could look like, this is what it could look like for you, right? If you join in and you become part of this. And alongside our amazing investors and partners, we've been able to invest and acquire in assets totaling about $95 million in assets under management. And we are very excited that the Rise is going to be our next opportunity that we are adding to our growing portfolio. So we are very grateful for the journey, and it's thanks to investors like you on this call. And our strategic partners, I talk highly about them because we truly are a team, and I'm partnering alongside Excite Capital, that's made up of Dr. Julius Oni, Leslie Awasam, and Tenny Tolafari, and EM Capital with Chris Lento, and then Crest City Capital with Brad Kanjamila. And our team truly has a wealth of knowledge and experience in truly knowing how to acquire, but not just acquisition. A lot of work goes into managing how we manage these assets, and we truly have a wonderful team that I'm doing this alongside with. Okay, so as I wrap up, the investment process is pretty straightforward. And again, our team will put a link to allow you to jump into the portal to secure your spot. It's pretty straightforward, right? When you access the portal, you will get a chance to talk with one of our team members just to kind of understand your goals. You will complete the application. We will hold your hand every step of the way. And then you'll get access to the PPM, which is the official subscription documents that were drafted by our legal team. You will also get access to the operating agreement, of the breakdown of the structure of this business, right? All of that is available in our secure portal. And then once you complete the subscription agreement, you will then wire your funds and you will become an owner. You'll get quarterly updates, you get monthly updates, you get quarterly webinar calls, and kind of just an updates on how the property is doing, the performance. You get financials on it. You have everything that you need to make sure that you're an owner in our property. And then you also get access to all our future opportunities. So the next one that we're thinking about, you'll be the first people to know about it. And then throughout the whole period, right, you will also benefit from depreciation and other tax advantages. And at the exit, you'll get, again, like we talked about in the beginning, you'll get full return of your capital, plus you'll share in the profits. So if you decide to move forward, kind of this is what it looks like. We are at the point that we are in the investment commitment phase. And I think we really expect to close within the next 30, max 45 days. And we're just going through final lending approval. So first quarterly distribution will look like Q4 of 2025, and then you'll get ongoing distributions throughout the entire hold period. Our exit plan is we are targeting 5 years to exit, and at that point you'll get full return of your capital, again, plus any share in profits. So a lot of investors ask me this, and it's how exactly can I invest in opportunities like this, right? Obviously, you can invest with cash, but you also can invest with a self-directed IRA. And what that looks like is a lot of our investors have old 401k or they have existing retirement funds. And so you can actually convert that, either of them, into a self-directed IRA. What that does is that you can then invest in alternative assets just like this. It really allows you to diversify beyond like just traditional stocks that you have access to, maybe stocks and bonds that you have access to with your retirement account, but you're still maintaining all the tax advantages in that retirement account. And a lot of question I get is like, will I get penalized if I'm using my retirement money to invest in real estate? And the answer is no, right? Because it truly is, you're investing from that IRA straight into the rise. And so you physically don't get access to that money until you qualify to get access to that money. So you're not penalized, you're not taking the money out. And that's something that a lot of my investors ask. Okay, so you might be thinking as you're sitting, like, I'm at a crossroad, right? You can continue on the path that you're on, which is work hard, earn more, but still trade that time for money. And maybe you're still thinking like, what if something happens to me today? What if everything starts unraveling? What ownership do I have, right? Or you can think about a different choice. You can think about the ownership paradigm. So you start to think about how you can build assets that work for you instead of you working for someone else, right? You can choose the path to get back your time, get back your power, get back your peace, all the things that we talked about. And for some of you, right, who are listening in, who are here tonight, this could be your opportunity to make that choice. An investment like the Rise could be that opportunity. So I don't want you to take it lightly. But here's what I want you to think about, right? What does your financial life look like if you continue on the current path that you're on right now versus if you start building assets today? 5 years from now, 10 years from now, 20 years from now, which version of the future do you want to live in? If you ask anyone, they'll tell you that like the best time to have started investing was 10 years ago. And that's what everyone would say. But the next best time is right now. So that decision, right, you can make it today and then you can compound it over time and imagine what it would look like 5, 10, 15, 20 years from now. That's what I want you to think about. But I also want to be transparent about something, right? These opportunities, they won't be available indefinitely. And we are at about 90% subscribed. The Rise, a lot of our investors loved it and they wanted to jump in very quickly. So we only have space for a limited number of investors to still come into it. So if it's something that you're really thinking about, I would say, click, I would say, get into the portal, fill out your information, talk to one of our team members. And if you have any additional questions, and then secure your spot. Because another thing to think about, right? The market conditions that we're at right now, they have allowed us to acquire properties like this at a discount, but they won't last forever because we're going to get to 2012 again, where things will start picking back up, right? Right now, interest rates are kind of stabilizing, institutional money is flooding back. And so these opportunities will start becoming scarce again. So the question is this the right time for me? Or why isn't this the right time for me? That window is kind of closing, and also the Rise is filling up. So the question I want you to ask is like, will you be positioned to benefit from an opportunity like this or the next one? So it's your time to make the decision. And that's kind of just where I want to leave it. So you have very simple 3 steps tonight. The link, which has already been put up. I'm pretty sure it's there so you can see it. Log in, review the deal, reserve your spot, get access to the subscription documents, and then also get access to the detailed deck. And then if you have any questions at all, we will be there every step of the way and we'll actually kind of walk you through it. So I started tonight by telling you what nobody has told you before, and I'll tell it to you again. Earning money and building wealth are 2 completely different games. Which game do you want to play? The Rise could be your opportunity to start building wealth. It's your opportunity to stop trading time for money, but really start thinking about building assets that really work for you. And so it's your chance to start thinking about how you can create financial resilience and that you don't have to depend on your ability to work 2,000 hours a year or whatever else that looks like for you. For some people tonight, right, this is your entry point into starting to think like an owner, starting to be an owner. So my only question is, are you ready to kind of step into this new wealth paradigm? Again, the choice is yours. I am here. Our team is here. If you have any questions at all, if you want to just understand who we are, what we're about, even more details about the deal, we would love to meet with you. Again, if you log into the portal, fill out your information, we will contact you and kind of take it from there. So I want to say thank you. I'm proud of myself. Stayed on there an hour. Thank you for spending tonight with us. I know that this is a new way of thinking about like how to build wealth. And I know that you might have questions about the process, the risk, the returns, how it fits into kind of your overall financial strategy or even financial strategy of your whole family. And that's exactly why we have these webinars, to be able to educate you on how to take that next step. So I want to open it up for questions if there are any, and kind of just help you walk through the process and then start investing. So I want to tell you once again, thank you so much for your time. Thank you so much for spending this evening with us. We are grateful because you could have done a bunch of stuff tonight, but you decided to come and listen in. So I hope this was helpful. I hope it was beneficial. And once again, if you have any questions, I'd love to answer it. On that note, thank you so much. Wouldn't someone have to pay so much after many deferrals? So can you elaborate on that question just a little bit more? Whoever asked it, I'd love to answer it. So if whoever asked that question, if you just kind of want to elaborate on it, I would love to answer it. For how long can we write off depreciation? As long as you have it. So if for this deal, if you invested $100,000 and you got $23,000 in depreciation, right? If you don't use all of that year one, you can roll it over to year two, and then you can use that. And if you don't finish all of that, you can roll it over to year three. So you have that. Now, I want to say something that that sometimes some of my investors don't know, and I want to bring it up. And good question, George. Is if you invest with your self-directed IRA, or if you invest with an old 401k or an IRA and you convert it to a self-directed IRA, you will not benefit from depreciation because that IRA is a tax-saving vehicle already. And so all the money that you're getting, all your distributions are tax deferred. So while you are investing with your IRA, you are not going to be able to benefit from depreciation. So I know you didn't ask that, but I know two of my investors asked that and it changed them. They initially wanted to invest with their IRA, but they didn't. And they ended up investing cash because they wanted to benefit from depreciation. So I hope I answered your question plus the next one. I think you said one more question. Okay, perfect. Is $23,000 and $100,000 just, nope, it's not for the first year. I read your mind. You get it in the first year, but you have access to it. So you have, for the life of the deal, you could just use it. So you have it until you run out of it. Okay. Okay, so I'll give everybody a second. If whoever asked the first question, if you want to clarify, but if you don't, maybe I can reach out to you afterwards and understand what you meant, and I can explain that a little bit better. But if there are no more questions, it's 7:02. I'd love to allow you to get back to your evening. I just want to say thank you to everyone who jumped on the call. And if you have any questions at all, please feel free to reach out to me or a member of our team, or jump into the portal, and then we'll be able to reach out to you and go from there. But on that note, have a very wonderful evening.